Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast from Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you bite-sized chunks of our industry insight and knowledge to help investors invest intelligently.
Yeah, so hello everyone. Hope you are doing well. So just before we dive into the podcast episode today, a quick look at what's happening in the market this week or in the news. Now, it's not strictly property related, but I thought this one was worth mentioning because it's actually a bit of positive news related to the economy. Now, we've effectively had reports from the Bank of England that the economy is set to grow at its fastest rate in 70 years. Now, what they're saying effectively is that this year they expect the economy to effectively expand by 7.25%. Ultimately, this is subsidised by the government incentives and spending, etc. But this would be a really large jump. I think the largest in something like 70 years. So, when you put that in proportion to what's happened pre-2020 or during 2020, sorry, the economy actually contracted, according to BBC, by 9.9%. So yeah, that contraction was the biggest in 300 years. So we're by no means back where we were. However, we've got the Bank of England directly saying the economy's effectively going to be expanding really well this year, and should see some impressive growth. So that's weighs well for general property investors, business in general, etc. So whilst I'm sure a lot of people and businesses are still struggling, it's great to see some positive momentum at least. So moving on from the economy and finance then, Toby, do you want to bring us into what we are discussing today?
Yes, so this week the topic we're going to be speaking about is city centre versus commuter locations or outer city locations. So we're going to look at the difference because there are pros and cons for both. I mean, at Track Capital, we are an advocate for city centre investing, but we do get asked the question quite a lot about investing outside of city centres. That question has been highlighted a bit more just because obviously coronavirus. You've probably read a lot of articles in the media like city centres are dead, etc., and really putting a negative spin on the city centre. So it is a question we've been asked more frequently. So we thought we'd do a show on that just to go through the pros and cons for both and sort of give our point of view and insight on both of those. So what I'll do, I'll start things off. I'm going to talk about the outskirts of the city centres. So we're just going to give a broad overview. So we won't go into too much detail because it is quite a lot to take on. But so on the outskirts, what you tend to find realistically is they will be more freehold, older properties. Now, don't get me wrong, there are still apartment blocks. However, you tend to find because there's more green space outside of city centres, the developments will develop out rather than up like we see in city centres. So you will find a lot more houses and freehold and, like I mentioned, older properties there as well. Now, this does come with more maintenance and I suppose management and attention, because if you're buying an older property, you need to make sure that it's kept up to scratch, well maintained, looked after. Otherwise, this can cause problems if you don't look after it, and that can build up and give you a very big bill. The other thing you need to think about is you will have to do a lot more due diligence unless you know the area. So some people do invest where they're living, but what we tend to find is, especially with investors in the south, where they live is very expensive and the numbers just don't stack up. So if you're investing in an area that you don't know and you're not looking in city centre and it's an out of town suburb or a village or something like that, you're going to have to really do some research on that and one, make sure that it is a good place to invest, because although these properties can seem very attractive from the price point and the yields, if you're investing in a village in the middle of nowhere, yes, you might pick up a house for a very cheap price and the yield potential is massive, but is there going to be demand for it? Is it a village where there's a very small number of people living there. So again, you're not going to have many people wanting to rent your property, etc., etc. So there's a lot of things you need to think of. Or is it an up and coming area? Is it a bad area? Where's the bad streets? Where's the good streets, etc., etc. There's a lot of due diligence that you have to do, and that's something we talk about quite a lot when it comes to due diligence, and how you have to be very confident on where you're investing. I've spoke about this before because I do invest in secondhand freehold properties myself sometimes. And you have to be very careful what road, what street, and what area you invest in. What you tend to find is, as well, on sort of outer city locations, is the properties will be more family orientated. So you are going to have families in the property, which again can cause more wear and tear. I know if I was renting a property with my kids at the moment, God help the landlord, because there would be
A
more
year's worth of your return.
exactly, there would be more than just a slight wear and tear. But yeah, that's some of the things that you have to think about, maybe on the more negative side. I mean, Nick, apart from those, is there any that you would add on that?
No, I think just to recap on those. So yeah, effectively what we're saying is on the outskirts, most of these commute out locations, you know, you're going to be finding fairly dated property, especially in the north of the country. It'd be, you know, rows of terrace houses effectively. So it's going to require a bit more time, a bit more commitment, looking after and maintaining them. You're going to have to do a bit more checks to make sure the area is right. And then you might find they take a bit more wear and tear, just because people that are going into brand new properties tends to be a slightly different type of tenant, and they might look after it a bit better. So yes, we are generalising, but you know, that's often a hot topic at the moment with the likes of the effects of COVID and working from home, etc. So it's certainly an interesting one, but I think that covers off the gist of the perhaps the downsides of the outskirts in terms of property investment. So what are some of the positive points then? So I'd say on the plus side, in terms of actually looking at the return on investment, you probably will find in most cases that the rental yield is going to be a bit more attractive if you're buying further out of the city centre. The reason being is you're obviously not paying that premium for the convenience of being in the middle of town, and you're just going to have to effectively buy a cheaper property where the rental still stacks up, so you still get a half decent return, and you, as a result, you'll find the yield is pretty decent. Now, with regards to the pricing itself, as we've touched on already, there can be a huge difference to buying a new build off-plan development in the middle of the city in the premium postcode versus buying a freehold terrace house on the outskirts. They might even be the same size. You could even, you know, match up the same potential tenant. Yet the one on the outskirts is going to be a lot cheaper. It may seem obvious, but you know, it's a big factor when you're making your plans and you know, you're budgeting effectively. So I'd say that's obviously another good one, being able to get in at a much lower entry level, especially those that are looking to start and establish a portfolio. And touched on what I said earlier, I think another plus side is we are seeing a slight shift of demand of those moving out from the city centre. You know, those looking for more green space, whether they're going to be working from home a lot more, might be, you know, going for walks, etc. at lunch. They might want that extra green space rather than being in the hustle and bustle of the city. Because the entry levels are lower, they might find that they can buy more space. So you get that you know, potentially extra study or the Zoom room, so you're getting a bit more working from home space, and it should, for some people, just make a you know, a more spacious and enjoyable living environment if they're spending a lot more time at home. Buying somewhere that's larger is obviously going to be more beneficial. So yeah, there's certainly plus sides, the only other thing I would probably add, now I've just thought of it, with regards to the commute about locations, you probably will find that the appreciation and the capital growth rate might be a touch slower than what you would get in the city centre, but we will cover that off in a couple of points further down the track. So yeah, that sums up the potential advantages, and then Toby obviously ran through the potential disadvantages. So I think now if we switch over to the city centre side of things, again, maybe going back to Toby's being Mr. Negative today, but maybe if we go back to the downsides of the city centre potential investments.
Yeah, I'll do that. Usually it's the other way around. I'm usually the
Yeah,
positive one.
I was thinking that.
But no, that's fine. Yeah, I think the main negatives, and again, this is probably the first thing that is highlighted when we talk to investors and we start talking them through some of our city centre location projects that we're marketing. And the main one is that they are more pricey. You are paying a premium for these city centre locations. So that's definitely got to be the first one due to the location. And as we say, it's always about location, location, location. They can be a bit more pricier. Now, this effectively can lead to slightly lower yields. And I think that's what sometimes people do struggle with. And this isn't every city centre, as in like you're going to get horrible yields. We don't want to make out as they're not attractive. They're still good yields, but it's only when you put them in comparison. But city to city does change. So if you look at Manchester in comparison to Liverpool at the moment, Liverpool, you're getting a more favourable yield. So if some people looked at Manchester as a city to invest and looked at their yields, they might tarnish Liverpool with the same brush and go, "Oh, there's no point even looking at Liverpool because it's going to be expensive and low yields, etc., etc." But it's not always the case. It is city dependent. So that's definitely something to to consider. I would say also, touching on an opposite side to what we spoke about with the outer city, is the sort of tenants that you get. They are going to be probably working professionals. They may not be around for as long potentially, because if you get two friends, which you tend to find, especially around London and I know sort of cities like Manchester, you'll get two friends. They might have gone to university together. They're going to share a flat. One ultimately might go off and do their own thing. So your tenancy lengths might not be as long as the outer city, because as we mentioned, families tend to be the outer city locations. They will stay in a property a lot longer just because obviously they settle down, have their roots there, so they can be there for many, many years. Whereas with city locations, the turnover, where I'm not saying it's going to be very, very sort of quick, but they might not stay as long as outer city locations. But I suppose city centre, that's sort of the main negatives that we know of. Nick, why don't you talk about the positives?
Yeah, just quickly going back round to that, that's actually a really, really good point. I think the word I'd probably use to describe it is the city centres are a touch more, in terms of the tenant base, a touch more transient. So you have people stay 1 year, 2 year, and they're in and out. So yeah, I don't think that's a point that many people always consider. If you do get a quality family tenant renting your property on the outskirts, it's likely they're going to be there for a significant period of time. So that is something that you might want to consider as well. So yeah, great points there. But okay, cool. Moving on to the positives again. So looking at city centre benefits. The main one, again, which we touched on earlier, as you can see, a lot of these do interlink, but appreciation. So most property investors will know that the highest rate of growth and appreciation is typically in the city centres, to where it starts and then it effectively ripples out, and then the commuter belt locations get to see that growth rate as well. So yeah, really aggressive capital growth is typically always found in the city centres. And moving on then, the tenant demographic. So as we touched on, whilst a lot of the tenants might be staying for a shorter term, so maybe a year or two, what you will find is a lot of them are in a stable job. They're happy to pay a premium to be in that convenient location, and they are probably quite reliable with their rental payments because they are in that sort of high caliber position, young professionals, executives, etc. Knock on from that is the actual demand in general. So if you are getting a good location, the same old phrase, location, 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 in a city centre, then the demand is ultimately going to be there. So you're going to have tenants that want to be near their workplace, they want to be near the social scene, the nightlife, the shopping, etc., etc. So if you've got a modern apartment catering to this tenant demographic in the middle of town, it's going to make for a really strong investment. And more on the area that we focus on, the new build and off-plan investment market, what you will find, and what probably a lot of our listeners have seen advertised, is rental assurances. So these are effectively contractual agreements with developers where the developers are fixing your rent for a certain period of time, or they're effectively underwriting a rental rate for you. So it might be, a 7% return for 2 years or something. So the developers effectively saying that they're going to make sure you receive that money. They're legally bound to pay that. So what you will find is they are typically offered on schemes where they're mostly being built. So in the city centres, it's very rare that you'll see a rental assurance offered on a new build scheme, which is in the middle of nowhere. It does happen occasionally, but what you'll find most of the time is they are in those prime postcodes. And just lastly, the plus side, kind of again taking into account all the factors, investment fundamentals. It's the absolutely foundation of property investment by where the investment fundamentals are strong. That's why London is one of the most established and best performing property markets in the long term in the world, because its investment fundamentals are so strong. So strong university and educational presence, great leisure, social and entertainment facilities, massive regeneration going on, stable convenient transport links, and then major employers as well. So most of those things are seen in the middle of the city centre. So when you look at that list of positives, I think it's safe to say that it's really strong investment case for buying in the middle of these cities throughout the UK.
Yeah, I think that sort of sums up the positives. I don't think I have any more to add to that. So I think in conclusion, and again, there is no one size fits all approach. Now, I think for us at Track Capital, we are more swayed towards the city centre locations, and that's predominantly because of the investors that we help and we deal with, and they are hands-off investors, remote investors, overseas investors. They want to be sort of stress-free investors. So city centres, they have all the investment fundamentals that we look for when we're looking at investment properties. They have lower risk, and that's because we know the demand's going to be there. There's always going to be people wanting to be in city centres, especially sort of the younger generation, the postgraduates, the young working professionals, because that's where everything's happening. That's where the place is buzzing. That's where they want to be around. So they're always going to want to be there for a number of years. So there will always be demand. They offer better growth, which I think is a big thing. Again, capital growth is something that we predict. It's a forecast. We can't guarantee it. So we have to look at the data. And when we look at the data and we look at the track records going back previous years, it's always the city centres that have the capital growth first. So again, if you want to place a safer bet, you're going to go to the city centres. Don't get me wrong. If you know something that we don't, or you know an area very well, and there's a little pocket where you think, okay, I know there's sort of redevelopments going on there, there's a regeneration scheme, and you know that very well, you're able to do that research, you might be able to pick out a hidden gem, but the chances of that happening are a lot slimmer, so the risk is higher. So again, it's always about minimizing risk, but that is dependent on the investor that you are. And yes, just in general, there's more demand for sales and lettings. So again, lettings, obviously, that's very important when you're renting the property out, but future exit strategy, there's always going to be demand for a property in the city centre, whether that's an investor or whether that's a first-time buyer or somebody looking to move up the ladder. There's always going to be demand there in the city centres. So for a more stress-free investment, and you want to sort of more hands-off, and maybe you're new to investing, the safer option is city centre. Now, that doesn't mean that outer city is a bad investment. It just means it's only good for a certain investor. And I can only give a good example. I had an investor that I spoke to a couple of months ago. She spoke to myself. I went through the details, gave her a call back a couple of days later to follow up. And she said, I think I'm going to go for freehold properties. So I said, okay, fair enough. What's your reasons why? She just said, I'm not too sure on leasehold. So I spoke her through that. And she said, no, I still want freehold. I said, where are you looking? She said, Liverpool. I said, oh, great. Are you local? She said, oh, no, I live in the south, but I can see freehold properties are a lot cheaper. So when I said to her, I said, well, do you know the good roads and bad roads in Liverpool? She said, no. I said, well, do you know where you live? She said, yes. I said, oh, have you, do you know the bad roads that you wouldn't touch with a 10-foot barge pole? She went, yeah. I said, well, how are you going to know where that is in Liverpool? And straight away she said, oh, I didn't think of that. I said, what about the maintenance on an old freehold property? Because they tend to be Victorian properties in Liverpool. So are you going to be happy with the work, and do you have the money to do the work? Not really. So when I started highlighting these factors, that's when she said, actually, no, I think it's going to be easier for me to invest in city centre, because she was going to look at Liverpool, but outside of city centre because of the prices. She looked on Rightmove and Zoopla and saw the cheaper prices. After that conversation, she switched her focus to a city centre location for a new build off plan because it was going to be a lot easier for her as an investor. But there are investors that are absolutely fine. They've got the time, they've got the knowledge, they can go visit these places, they can maybe do work themselves, maybe they know contractors, and it is absolutely fine. But ultimately, stress-free, hands-off, less risk to a degree, city centre is where you want to focus. Hope that summarised it. Nick, have you got anything else you want to finish up on?
No, it's a good case study there, and I think it's a conversation that we probably have on a daily basis. Cheap is not always better. That's obvious to everyone, I think, and so it's a case of not only the time commitment and involvement required from the investor, but it's also the performance as well. For me, that's the main thing. If you're holding a property for 5, 10, 15 years, you want to make sure you're getting the absolute most out of it, and that capital growth is really where the wealth is going to be built, and that's mostly focused in the city centres. So I would just reiterate that point, but hopefully that's all clear for our investors today. So yeah, just wrapping things up then, moving on to next week, what we've got in store. So we're going to be going over serviced accommodation or short-term lets, which is a couple of key phrases that investors might have seen advertised or mentioned by ourselves previously. And effectively, it involves everything to do with letting properties on a short-term let basis to visitors entering a city for a couple of days or a couple of weeks. So we'll go through how your investment strategy can effectively fit around this, how you can take advantage of it, what the risks are, and ultimately give everyone a really, really strong picture of how that investment model works, because it's certainly something that we focus on heavily. And just in addition to that as well, to give everyone a look into the future. So in terms of what we've got coming up on the podcast, we've got another exciting developer coming on board soon. I won't reveal their name now, but like we've done previously, we'll go through the developments they have on file, what their future plans are, and learn a bit more about the company from a developer directly. This is quite a substantial developer. You're talking about over £1 billion portfolio in construction and built. So yeah, it should be really, really interesting episode, that one. And then hopefully we'll be looking more from the investor side. So eventually we're going to get a contact of ours on from an FCA regulated company who helps set up and manage limited companies for investors. So buying in a company name versus buying in a personal name, I think that's going to add a lot of value to our listeners as well. So we've got that, and then hopefully some more sort of finance and mortgage bits and bobs coming up in the future. So exciting stuff in store. Short-term lets next week, and yet today was hopefully really helpful to everyone as well.
Excellent. That short-term lets ones is going to be a good one. Service accommodation is definitely something that is getting more and more popular and can be very, very lucrative. So yeah, it'd be good to let our listeners know if they don't know about it already. But yeah, no, that's been a good one today, and we will see you next time. Bye-bye.
Thanks, everyone. Bye.